Hey, what's up, guys? It's your boy MC5. We are back, baby. Long time coming. A couple things were definitely giving us the body slam as regards to our schedule. I started working nights. That kind of absolutely slammed me because we were trying to get this project done. And then the weekend we had my younger sister's wedding. So the baby got married. The baby of the family got married. So definitely me and Q, we went down there to see that, and it went really, really well. So shout out to Sarah, and she has a new last name. So it's surreal, man. It's happening real time. Your sister, man, getting married. So, but coming back to the charts, it was a pretty heavy weekend, and unfortunately, we were not in the saddle with you guys. I do have to apologize for that. But the good news is that there is a lot to bring you guys. So we're gonna have a lot of juicy nuggets coming at you today. The crazy part is we're gonna like just kind of dive right in here. We want to not waste a lot of time here, but the market absolutely gave an amazing opportunity. Some people see it as a real kick in the fanny. I see it as a really crazy opportunity. If you're looking at the bar charts that we have on the screen here, what you'll really notice is no sector was immune. No sector was immune to the drop on Friday. Now, why is that good news as opposed to bad news? You're like, wait a minute, the market dropped pretty much like 10% over the weekend. Some crazy like 5%, and over the past month and a half, about 10% in the market has dropped. But why is that not bad? It's not bad because that was caused by, typically when you see the entire market like sucking like that, it's typically not bad for your overall portfolio. It does mean that there's something that happened. You need to figure out what it is. So what happened, and we're going to go to our handy dandy, very free tool, Forex Factory over here. And we'll show you what happened on that Friday as well as earlier that week. So earlier that week, they did have a Fed funds meeting. Nothing really changed, but more importantly, this is what did change. Let me find it for you. Not consumer confidence, not JOLTS jobs. It was the nope. Just found this. That has that. Nope. Unemployment. There it is. Okay, unemployment claims. Look at that. So what it is previously in forecast, it was actually forecast to go up, but what happened was it went up a lot more than expected. And when you think about unemployment claims, going up isn't good. So you're seeing unemployment claims like really rise. And so for a market that everyone's keeps saying, hey, the job market's going to hold, we've got inflation, but the job market they've been touting the job market as the base number, why they say they're not going to cut rates. But we see here that there's a large spike in unemployment claims. That isn't good. To add insult to the injury, right? Your manufacturing PMI basically says your output in the manufacturing sector, how well is it? That actually went down a couple points. So manufacturing took a slight hit, but really unemployment, what they've been touting as like the safety backstop, kind of fell through. So people at home are being affected. People down, like when I say in the real world, sometimes their numbers can be disassociated from the average Joe, which is us, right? And so those numbers are telling you, hey, the base at which all this market data is coming out is being affected, right? People's actual way to earn a living. Nothing else really matters if you're unemployed. And if you think that most people, if you're unemployed, if most people today, employed or unemployed, like have a hard time handling $1,000 expense, that could be a problem, right? And that's not me saying that. That is a lot of studies that they've been doing here recently over the past recession, over the past year. People are dipping into their savings. People it's kind of rough out there as inflation kind of creeps up. So buying groceries on credit, paying bills on credit, stuff like that. Really vicious cycles you don't want to see people get into. They need relief, and they don't know where it's going to come from. So, hourly. So another thing too, like on Friday as well, non-farm unemployment changes again. That was a really big kick there. It's red for a reason, right? The unemployment rate basically rose from 4.1 to 4.3, and average hourly earnings actually decreased. So basically saying the fundamentals of the market, the fundamental, are people working, can people earn a decent income, all those numbers were affected. And that's going to drive market sentiment into the future as regards to, hey, do people have disposable income to purchase, or is it just these banks competing against each other? So coming up this week, I guess what we have, since we're already here, not really too much going on. I'm gonna refresh this just to make sure we don't have any new developments here. Nope, doesn't look like it, right? So Monday, this is Tuesday, going into Wednesday. Up this week, nothing really for the U.S. We kind of already took our beating there. And then Thursday, U.S. also has again unemployment claims. So these reports, they kind of come out every week. So it's not like this jump happened over the period of a month. No, this is over a period of a week that we kind of assess this stuff. You got another unemployment claim on Thursday, and then on Friday you got unemployment change and unemployment rate. That's going to be for Canada, but the U.S. has unemployment claims on Thursday. So big deal for North America to find out if you're working or if you're not working. So get to work, right? And so kind of diving what's next. What does this also mean? People have been talking on the Squawk Box, that is the general news outlet. I don't necessarily heed their advice, but I like to hear what their assessment is. It's not going to affect how I trade, but I like to see like the people that are in the know. Maybe you're in the rooms and somebody leaks something, right? Really, you're looking for news, the rumor that somebody might leak something. But we have a tool that gives us all the information that we need, that we can make the best decision that we'd like the key in on, and that is the FedWatch tool, right? The CMEgroup.com. Okay, we are looking. So before, we've been talking about the current rate is 5.25 to 5.5, right? The talks were 5 to 5.25 before. Remember, it was at like 96% at some point, and then it lowered. Well, now in the September meeting, they're talking about actually 77.5% chance that it could be 4.75 to 5. So it comes down to people are assessing that they make a larger rate cut. Now, why is that good for us? Again, I want to take you back to this. The market reacted off the news, but it's in unison. So it's not like people can't find another job. There's plenty of jobs out there, right? As we were going to the airport, TSA was hiring, my firm was hiring, and like everywhere I look, you can get a decent job. I won't say it's not going to be six figures, but you can work at TSA and then be pretty well off. There's also some online stuff that is pretty lucrative. It is about volume. So I would essentially say like you can make a decent like $25 to $30 an hour if you really just research what your online options are. It's almost like a online gig economy. Like you can listen to like certain stuff online and like make subtitles or manuscripts for that stuff. They need stuff like that. So I think there's a website out there that allows you to make like $10 or $15 for assessing people's websites and writing a survey on each website you assess. So that can be that can add up pretty quick if you think about it, right? You can essentially do 8 hours of work, make 80 hours, making $80 a day, for 8 websites. That's pretty good, right? Just do 8 websites a day, you're good to go. So it's a good side hustle for those who might be struggling in the jobs department. But again, if the market is pulling back, respectively, altogether, all sectors, right? It's reacting off that news. That is good, because that means it's not like there's an advantage somewhere and there's not. The overall market that essentially rises at 7% has to have a natural cyclical motion. It has to go up and down, up and down. Can always go up. So we've been putting out in the videos, the market will pull back. The market will pull back. We are diversifying into other sectors because we believe the market will pull back. There was a pullback. Something's going to break. The Fed has been telling us something. We want to keep the rates high because we want something to break. And what do they mean by break? There needs to be a catastrophe. Maybe several banks collapse. Maybe unemployment goes, way high. Maybe war, something like that. Something needs to break before we actually decide. And they said that because they really want to cool inflation down, right? They really want to get ahead of it. I do think it's good that they do that. I do think the markets had priced that in, and they had, so like this pullback right here was them pricing it in. If you're watching where my line is, that pullback is basically the market kind of pricing in that aspect. And then once it priced it in, it started to rip, right? Because they're anticipating, well, we're going to sell off a little bit, get ahead of this, right? Because you have to, sometimes bigger corporations like bond markets and stuff like that, it takes them a while to unwind some of their financial instruments. They can't just like we can go in and just drop our 1,000 shares of whatever, AVGO, QQQ. They can't just do that because people are monitoring heavy flow. They could almost cause let's just say sometimes it takes them months, weeks, or even months to enter or exit a position. So they kind of have to be a little bit more tactful in long-term thinking. They can't just spike drop, right? It is no bueno, right? It doesn't look good. So with this happening and the entire market pulling back, there's news behind it. This could be the break that everyone's been talking about, that the Fed has been looking for. Now, what we're going to key in on is the fear factor of it. So we want to take a look. We're going to come over here to the charts here. We're going to take a look at the VIX, right? We're going to look at the VIX. Now, what is the VIX? Historically, the VIX has been what we call a fear index. It's basically how much are people worried about the markets, right? So this big spike here was essentially COVID, when everything was shutting down. And at its high, it was 85.47. This also is a good thing to look at when you're looking at premiums. When there's a lot of fear in the market, being able to sell at a high premium is good. So if you have an options contract, you being able to sell at premiums is great. Why? Because those contracts have kind of been inflated due to the high volatility. So high volatility, if the volatility squeezes, you're getting that squeeze of premium, right? So that's a juicy nugget right there, right? With the VIX getting as high as 65, really 65 and a half. With the VIX getting that high and it just being off of unemployment claims, and the previous, like in the previous future of rotational highs was at 85, but this is when the entire market was shutting down. If you notice here, we can look at it like 3.9 ish in 2020, essentially 2020 3.9. Let's go look at SPY and see when that was. 2024, 2020, 23. Go back all the way here, 2020. Right. So you're basically looking at COVID. That's how drastic of a drop that we're talking about when the VIX gets that high. So at 85, the whole market basically said we're shutting down in like February, right? The market said they're going to start shutting down. They're going to start going in quarantine, and the market took that news and ran with it. And at the lows about this week, the VIX was at a all-time high. Fear was in the market, selling, heavy selling was in the market. And the next week, in the week after, so you only had 2 more weeks of basically essentially hitting all-time lows. I'm not saying that it's going to happen again. Markets don't necessarily repeat, but they certainly do rhyme. And noticing that, hey, the market pulled back pretty considerably this week, is rebounded a little bit, but because the VIX had hit 60, right? And that was just weekend numbers. Now, that doesn't mean the VIX can't spike back up due to, let's say, there is some hostilities on the horizon around the world, right? There could be a continued escalation. What was going on in the Middle East? There also is some red lines being crossed that Russia has claimed in Ukraine. All those things, Yemen is still trying to choke off the straits there. It's just kind of a lot going on around the world. So just got to keep in mind. Now, keeping that in mind, right, I don't want to let this kind of slip away. That's also essentially with stuff like that going on, we made a pretty nifty play in Raytheon, and we're going to show you that here. We're just going to zoom in here, kind of on the play. So as you notice, we have an arrow here, and we have an arrow here, and then we have an arrow here. For us, that's our own way of kind of like, I don't like say color coding our entry, generally where our entries and exits are, right? So as we saw Raytheon, we've been watching Raytheon and Lockheed Martin, LMT, right? We've been watching both of those, and as they're, I liked Lockheed Martin, but I also liked Raytheon a lot more. For the reasons of the unbalanced volume being a little better, and the pullback being a lot more significant, and the rise being a little bit more pronounced, right? These two dojis gave me a nice juicy risk to reward, as opposed to LMT. The structure, basically the price action basically looked a little better on Raytheon. Both plays would have worked out good, but if you notice here, the unbalanced volume was a little bit more shaky for Lockheed Martin, but it was these have been ones that we've been eyeing for a little bit, because we're like, hey, war's on the horizon, and for our defense sector, we keep sending weapons overseas, which means a lot of that money that's being earmarked for Ukraine actually is making its way into NATO countries to pay for weapons, right? So what really is not going directly to Ukraine is going to, Lockheed Martin, Raytheon, DARPA, maybe some NATO members that have like F-16s or SAM weapon systems that Ukraine can use, tank weapon system, and we'll pay for it, right? Because we earmarked it for them. That's kind of where it's going. So if you notice, even with the pullback, even with the pullback that happened in the week, Raytheon really didn't feel that. I mean, it felt it a little bit, but not to the extent that the market felt it. So when you look at like locations of safety, yes, you got bond and gold. We'll take a look at that as well. Bonds and gold that actually saw an increase, which are running to safety in times of war. You see stuff like this that, again, the markets don't repeat, but they certainly do rhyme. And we capitalized really, really good from buying essentially a couple contracts at 103 and being able to let them go within a 2-week time span up here at 114. So we absolutely love that push straight into the weekly 3 ATR. Textbook, strong uptrend, kind of pulled back, gave us a nice buy trigger above the previous week's high, above the 8-pair moving average. We took that immediately. Right? As it broke above that range, we went on and took that buy there, and then it went on and popped. to the upside the next week. I woke up, I was like, yo, what is going on with Raytheon? And it was a good look. They had pretty good earnings, right? So shout out to them. We went on a roll. The contract, it went up a little bit, but with the volatility and the VIX being so high, I didn't want to spoil the party. So I went on and basically let it go at break even. It's already at 3 ATR. Let it go at break even. Ideally, what you could do is, if you really felt like it was going to pull back from there, you could hedge, right? Stay in the uptrend, but hedge. But we wanted to move our dry powder around a little bit. So since we had one in the hand, we wanted to allocate it to stuff that's coming out. So basically, with what has happened, this was a grand opportunity for you to get into the best blue chips that you could afford. Having some dry powder on hand is good, right? And we took out of this winning play that was really extended. It could have more upside, but we took that as like, hey, are we going to look to be in Raytheon, for the next 20 years? Is that the best bet? Or would you rather be in something like Apple, Amazon, Broadcom, Nvidia, right? So that's what we're going to look at next. We took that play off the board with the increased volatility, and we got into something that was on a juicy discount, on a very, very juicy discount. So let's take our first look at our one of our favorites, NVDA. Here, we've been telling you guys, we've been saying it and saying it and saying it. When it was like up here, almost a month and a half. Like when it was up at highs and it rolled, and everyone was talking about, hey, do we get Nvidia? Do we not? I was a staunch speaker of do not get it just yet. Wait for it to come to you. Wait for it to buy trigger. Wait for a good pullback. And sure as I'm not saying like I'm a guru or anything. That's not the point. This is basic market analysis. This is basic cyclical movement. This is basic buy low, sell high. The market will present you an opportunity. You will get FOMO, but the market, even here, presented you an opportunity to take the buy. On the weekly, even after it had been extended up into 3 ATR, there was a brief period where it went sideways, it dipped, gave you a nice juicy pullback, and then came back up and gave you a very nice buy trigger, especially with this week, and then it runs again. So there wasn't exactly a buy trigger, but at this point, there was no buy trigger, meaning it wasn't above the 8, it wasn't above the previous week's high. But we went on and took that buy because when you look at the overall chart, I'm looking at it from the standpoint of, was this risk profile for the year, right? We got a leap contract. Is this risk profile for the year good enough, right? And for me, I'd say yes. When you're looking at, and let's go, we might even be able to pull it up here, right? And let me show you why I took this stance, and this is going to be very helpful for a lot of people that when you're looking at long-term plays, this is going to be pretty helpful. So, okay, we're at our shout out to Qualtron and the insight for what we have, NVIDIA, right? The price had a pretty juicy pullback, but when you look at the revenues, right? Revenue for Q2 has been increasing. So the fundamentals of the company have been increasing. The cash to debt ratio has been definitely widening, right? The debt has increased, but the cash has also increased considerably. Revenue by segment, data centers, that has been increasing. So its basic business model has been increasing. Okay, so it's not like the subsectors that could come and go. NVIDIA and their centers in driving AI revenue, that is on the rise. They're based where they're making their bread and butter. That is going up. EBITDA going up. Free cash flow going up. Net income. All the fundamentals that you would like to see, even the dividends in Q2 are going up. So would you want to be involved in a company like NVIDIA? I would say yeah, absolutely. Yeah, so we're looking good, right? Some analysts are saying, I don't go by what analysts say, but They're saying like 400 as a price target. I think that's crazy. I was thinking more like end of the year back to highs, right? Something normal, right? And this risk profile is one that I could see. Okay, we're not just making the decision based off of just price action. We're making the decision based off of one, we have very high brand recognition, almost has cornered this space. Three, nice juicy pullback in a cyclical form, right? But the fundamentals of the company haven't changed. That's three. The four, right? Even with unemployment claims spiking, a company like Nvidia is poised to move in with being the leader in AI chips. If you have an unemployment problem and you don't have new employees, companies are going to do one of two things. They're going to take that hit on the chin and probably get beat out by a competitor who is going to adopt AI. So the future really is moving to AI and computer chips taking over those jobs. That's why the unemployment numbers aren't necessarily a drag. It's just a drag on the economy. But there is a glimmer of hope there. And for those four reasons that I named, NVIDIA makes a lot of sense. NVIDIA makes a lot of sense to me, right? So when you're looking at the fundamentals, yes, the price is pulled back, but all of the other factors that we're looking at, EBITDA, revenue, cash to debt, net income, free cash flow, dividends, shares outstanding is actually pretty steady. And expenses are rising, but when you think about like the cost of like doing what is your primary business, data centers, yes, if your costs are rising, it's probably due to that. it just makes sense. But you can see the cost of the debt increasing actually causes a massive increase in revenue. So if debt increases revenue, you're gonna take that deal. And especially if the revenue can cover the debt. If the revenue can cover the debt, man, it is a beautiful thing. So from the fundamental standpoint, Nvidia pulling back like this, we decided to take the leap contract there, and we didn't even get it at the most perfect opportune price. Like we could zoom in here. The low would have been at the open. So hold on, excuse me. Sorry, zoom out here. Thank you. Let's get to the part where we bought. Yep, cool. So ideally, excuse me. Right, ideally, we didn't even take the low. We kind of wanted it to clear, kind of actually really push. We didn't want it to just get bumped by like a support level. We wanted it to kind of really move, and then we'll take it. And that's exactly what we did. Some people are like, oh, if you thought that way, why don't you just buy the low? Well, because there's a lot of volatility. So if we just took the low willy-nilly, it could come up, it could hit resistance and immediately fall. Ideally, you'd want to see if you think it's going to go up for like the next year. If it goes up, for an hour and you don't buy it, and you don't think it'll go up the next hour, I would just still wait then, wait for it to keep pushing. So we ideally saw it move, and we're like, okay, we believe this is a sustainable move. Really, buyers are stepping in here, so that's good. I guess the next thing we can take a peek at is some more blue chips. Really stuff that is going to be around, name brands that are on a discount. Amazon is one of those brands, right? This is a weekly over here. This is a daily over here. Amazon being Amazon, the world's online marketplace and online delivery for retail goods. Being this cheap, it's almost a steal. It's almost a steal, right? We have some Amazon already at a really good price, but if you miss that Amazon boat, I encourage you, I implore you, don't miss this one. You can wait for a pullback, but the question you have to ask yourself is, let me go full screen here. Am I okay with this risk to reward? Am I okay? Am I okay with Amazon being, 161 and having potentially immediately $40 of upside long term? I'm talking about like 5 years. $40 of upside, and I might hold it, back into the lows here at 131. Right? If it goes below that, probably let it go. Are you okay with that? Like almost 1-to-1. in Amazon? I'd say yes. I'd say the probability of Amazon not being a more profitable company next year than right now just doesn't make sense. This is an opportunity to, just like in COVID, did just like when the Fed started hiking, how many people would have loved to buy down here or even right here, and take that nice juicy buy there, or take this buy trigger right here, or take this buy trigger right here, and then hold it for a year and see that kind of returns. Well, you might not get all the way down there, but this is probably the next best thing, right? And if you're looking for a buy and hold, this is a prime opportunity for that. We can also take a peek at one of my favorites. Now, before we go over there, to look at our boy who has been making definite waves in the space, Palantir, absolutely crushing it. Even after the weekend pullback, like the next week, it's already back up into that range that it was previously, between $25.39 up until the 27.82. So it's already back up into that range. That should tell you something. Now, why should that tell you something? Let's go take a peek over here real quick. We're going to type in Palantir, and I'm going to show you why. Again, fundamentals, they really kind of they won't lead you astray too much. Okay. Now right here, the price did dip, right? But look at that. That's massive, right? Revenues continue to increase quarter over quarter. EBITDA good to go. Cash to debt is like crazy. Yeah. So when you're talking about a company that is actually got a lot of free cash flow as well, you're looking at this, and right now the price is only 20. What's the price? It's up 60% on the year, right? Up 60% on the year, and its current price is only 26.59, and it's making waves in the space, right? It's definitely breaking through with a name recognition. I see this company probably doing pretty good. Again, none of this is financial advice, but the fundamentals, when I say the fundamentals, they're pretty much there, right? Cash to debt's there, revenue's there, free cash flow's there, and seeing how the market reacted with it being that cheap, they definitely took it and really ran with it. It was like a godsend, like the drop, but then the earnings came out and we're like, oh, well, probably need to buy some of this while it's hot. So taking that buy doesn't mean it's going to stay up there. It just means that getting in at a discount and a nice support level, the market showed its hand and said, hey, this company, even when everything's going on, we believe this company could make huge waves. And if you look at what they're doing and their leaps and bounds into data sharing, as well as in like helping police with like street I want to say like surveillance and border security in the security sector, and getting government contracts. The government pays like really, really well. So if that's your primary customer, the government and police forces, those aren't going anywhere anytime soon, and you're a leader in the space, and your ability to pull data and access things at the drop of a hat, that's really their business information, you're going to do very well. So we're definitely we didn't scoop any up. We already had a pretty big we were already pretty built in Palantir already, so we kind of held off on that one to get into ABGO, which is Broadcom. So Broadcom, definitely like that pullback there in Broadcom. Broadcom is another one of those that just had a 10-to-1 stock split. So historically, when companies do anywhere from like a 5 to 10-to-1 stock split, the chances of them rising around 12% that year is pretty high, right? It happened with Tesla. It happened with Nvidia. Right, same thing here. This 10-to-1 stock split, yeah, it's at all-time highs, but it makes the stock affordable for the average Joe. And because of that, this pullback was very nasty and well wanted. Most, if you wanted to get into the stock, now would be the best time. Like, I mean, to do it, or last week for sure would have been way better. But yeah, like looking at that from the standpoint of blue chips are on sale. They're still kind of on sale. So if you are looking to average into some heavy names, I think now is a good time to do that. And then last but not least, good old Apple. So Apple, same thing, is on sale. Don't think Apple's going anywhere. Revenues, let's go take a look at Apple here. I'm gonna pull up, and we'll go to the numbers here, and then we'll teeter it off, right? So price has kind of been obviously kind of been pushing down with the rest of the market lately, and yeah, revenues have kind of been slipping a little bit over the past, I would say. This is quarter 3 2023, 1 2 3. So from quarter 1 to quarter 2, slight slip. Okay, but do I think that Apple's going anywhere anytime soon? I don't. When you look at the cash to debt, though, debt's been decreasing, but so has cash. So not exactly what you would want to see. Not ideal, but pretty like there's comes a point where you're just like, okay, I mean, I can get into a stock when it's at all time highs, or I can get into it when it gives me a nice discount. I want to get into the stock. I just can I accept the risk of the stock. So we didn't get a lot. Did get a lot of Apple. But it, as a regards to pulling the trigger and seeing a good deal, I would say, yeah, I think we did pretty good with getting into Apple. So we got into Apple, Broadcom, Nvidia, and shouts out to our boy and our favorite Palantir. We're already in Amazon, but ideally, if we had like unlimited funds, we would probably be getting more Amazon. And probably more Palantir, because I think it's an absolute beast that is poised to just like explode. I believe it's already undervalued. The stock probably should be at $100 right now. In fact, what was it previously? I don't think it was close. Yeah, so the stock has already been up to $45, and that was before it was profitable. So before it was profitable, they were at $45, which is pretty unique. And the company wasn't even profitable then. So now that the company is profitable, we believe it has a lot more room to grow, but it can be extremely profitable with the amount of cash that it has versus cash to debt, and revenues constantly increasing. If that continues probably for another couple of quarters, you could see this thing absolutely take to the moon. So guys, we really appreciate you joining us. If you like what you've been seeing, go ahead and hit that like and subscribe button. And before I do anything else, don't hit the like. Well, do or don't. I don't really care. But before we push on, I wanted to show you a play that we took in the queues real quick before I forgot. It's on my board, but I kind of did it out of order. So we did. Here's another thing, right? And this is another juicy nugget for you guys in learning. Don't be afraid of volatility. Just find the right setup for volatility. Don't be afraid to take a play just because the market has a VIX of 65, right? What you do is you just switch your setup. Instead of buying a call outright. Let's say, for example, you go to the trade tab, right? And you're like, oh man, if I get this contract, right, it's gonna cost me, instead of it normally being $1.20, it's costing like $300 or $3.30, something like that. You're like, wait a minute. How do I set this up to get the best bang for my buck in volatility? I don't want to be a buyer when premiums are at all-time high. What does that mean? Premium being at all-time high. That means to buy the same item, it's costing you more. To buy the same contract for the same time, it's costing you more. And if volatility decreases, you're automatically losing money. Like if demand for that contract decreases, the evaluation of your contract is going to decrease as well. That money doesn't just disappear, it goes to the seller of the contract. So why not just be the seller of the contract, just in the opposite direction? Now, how we played this was we decided to once the news that this big gap came in, right? We anticipated a gap fill, or at least a half gap fill. Didn't get the full gap, but we got the half gap fill. So on the Qs, we went on and took a butterfly position. What is the butterfly? We sold or bought an out of the money contract, like call essentially, and then we sold two way out of the money contracts, and then we bought a further out of the money contract. So basically, you have 4 contracts. 2 of them are buys. There's a low buy and a high buy, and then 2 of them are sells in the middle. And what that does is it give you a nice, let me see if I even have my analyze tab pulled. Nope, it's not in there. Okay. I mean, I could set it up for you really quick. Actually, let me do that. If you've seen some of my other previous, this by no means financial advice, but this is to educate you on what is possible. So let's say, for example, I believe the stock is going to go up, right? And I don't want to pay $2.46, right? So let's say, for example, but I think it's really violent and it's going to be volatile, right? So I think it's really going to move. I could say, all right, I'm going to be cheap here. I'm going to buy this contract, right? Buy this contract. And then I'm going to 1, 2, 3, 4, and we're going to sell these 2. Okay. And I'm just controlling and clicking and go 1, 2, 3, 4, buy this one. Okay. So it automatically cues in. It says, okay, you're buying the 450 strike call. You're selling 2 455 calls, and you're buying the 459 call. Now, let's see what that would look like. So when you're looking at like profit to loss, essentially, right? If this play moves, right, it's telling me to purchase this instead of the $200, and I believe it's going to move in my direction. This play only cost me $49. $49 essentially to get this play. Now, if it gets pinned, the pinning price could be as high as $443, which means that at expiration, if price ends at, and this is kind of hard for it to do, but if it ends at 443, right? Or if it ends at 455.08 ish, right? That's where the price has to land. I would be getting essentially $400 from a $40 play, right? Essentially 10 to 1. But it doesn't necessarily have to go get pinned for you to make money, right? The low strike is where you can actually start to make money. And if you look at the cyan line there, that cyan line over here, watch the cyan section when I'm hovering. So at expiration is the blue line, meaning once time expires on the contracts, which is that day, if it lands at 451.17, then you're gonna get $68. So even if it just moves in the money, you're gonna get your money back, right? Now, if it continues at expiration, then kind of higher up there, it increases in value at expiration. But even before expiration, let's say you believe that price is going to pull back on you, right? Then you could even sell it at this point for a juicy return. In this case, it was like $73. If it where our mouse is right now, you would be able to recoup your initial investment and make a decent profit of about like 30%, right? So we went on and took that. We went on and took that style of play. We'll actually minimize all this stuff here so we can actually see the chart there. Close this, close that, right? And we'll do this, right? So we took that play on open. We're like, hey, the gap could fill, and the VIX is very high. So I think we got our contract for the 433 level. So 433, it was way out of the money, because 428, you're talking about $5 of movement, just for it to get in the money. But once it did, and it cost us at the time, I was trying to place it quickly. I think at the time it cost us like $1.73, right? $1.73. But what we returned from it profit wise was $1.50, right? So even with that massive movement, and we went on and profited from the volatility, and you can pull it early, right? If it's going against you, you're like, okay, I don't think it's going to actually go up. It was a long shot. You can sell it maybe at 50%, right? Because it has some time on it, but it's cheap, right? Instead of it, I think the contracts at the time just to buy at the money were like $3.30. But I basically essentially cut that in half and increased my risk to decrease my risk while increasing my potential reward, by just setting up a different play. With the VIX being so high, typically price is going to move. It's going to fluctuate. It's going to be violent. It's going to be volatile, typically. So we took that opportunity and we were able to make like an 85% return on investment just by switching up the setup. Just by switching up the setup. We cut our risk down by 50% and we increased our potential reward, which we did. So, shouts out to us for making that play a reality. And it did end up like staying above that area just slightly, and giving actually a little bit more wiggle room. We just went on and took the profits there at like 85% return on investment, which when you think about it, it's very hard to get 85% return on investment on anything unless you're holding it for a very long time and it stays in business for a very long time. But on one play we did that. So shout outs to us learning, shout outs to the mentors that have been teaching us, and thank you guys, shout out to you guys for tapping in with us on our experiences with trading. So you guys have been awesome. Thank you guys. Have a great day. Tap in with us soon. Like, comment, subscribe. Goodbye.